that get you guys pumped up? Are you psyched? All right, welcome everybody to the 37th annual Marine Money Week. It's our final day. We have like an unbelievable day today, and just couldn't be more excited, and really excited to kick it off with the crude oil tanker panel. Obviously, there's a lot of stuff happening in the market, and looking forward to hearing about that and what you guys are seeing in your companies. And we got Omar Nokta from Jefferies leading this group, so very fortunate to have him. So I would say, let the games begin. Come on up. Total artistic decision.
All right, thank you, Matt. Thanks, Mike. Thanks, Lorraine. Thanks, everybody at the Marine Money team for organizing this conference. Yeah, very happy to kick off day 3 of the conference with this crude tanker panel. Eric. Obviously, as Matt said, there's a lot going on, and I'll introduce the panel just very quickly. We have Mikkel from Teekay Tankers, we have Svein from DHT, Lars from Frontline, and Lois from International Seaways. On average, the companies that they represent are up 30% this year. Frontline, you're in the lead, up 42%, but everybody's had a very strong return, far outpacing the S&P, which I think is up 2%. But the best thing about all this is that all of your earnings are down this year, right? So it's a clear outperformance. When we were kind of planning this with Matt, we were talking about what's going to be the discussion. It was going to be the VLCC party. When is it? Are we going to be at it when the conference starts? Are we going to be pushing it out? And basically, I'd say about a week ago, it seemed that we were all kind of throwing in the towel, kind of thinking maybe we're not going to see much. VLCCs had kind of languished, fallen into the 20s. We hadn't seen rates that low in a few months, and I think people were all starting to think, we're going to push it out till maybe September, October. And then, of course, bam, things change starting late last week. Different type of fireworks in the Middle East market, and here we are. So maybe I can just kick off the conversation. Speaking of fireworks, Lars, maybe you have something to say about what's happening in the Middle East market.
Yeah, this is on, yeah. Yeah, it's actually not a laughing matter, because what transpired with us on Monday is the nightmare of any ship owner sitting here. And I appreciate not all of you are seafarers. So just to give you kind of an impression of what's going on, you have a 3 football field long tanker fully laden with crude oil, sailing at 13.5 knots. And then all of a sudden, you end up in a collision with a vessel that you don't know who owns, you don't know who manages, you don't know who insures. Luckily, it all went well, incredibly actually, looking at some of the footage. But it's customary in such a situation that you as an owner establish contact with the other owner. This is kind of basically to try and manage the situation, not discussing who's at fault, but just to manage the situation and keep the seafarers safe and the environment protected. This was not possible in this instant. And it just explains how crazy this market has become when this can happen. We have some fellow owners that have experienced some of the same, but this is the first time Frontline is exposed to it. We've been very vocal on kind of how dangerous this situation can become with the dark fleet. But here we had a very, very close call of having 2 million barrels of crude oil in a big sheet in the Middle East. So I just, it's a super scary experience. I'm very happy to share that we have established via local agents that the other ship's crew are safe in a hotel in Fujairah. But it's just insane that we are the ones who have to communicate this, not the owner of that vessel. So I just want to say that. But luckily, it went well, and hopefully, we will learn from this experience. Thank you.
Thanks, Lars. Do we know at this point what sort of caused that? There's been a lot of discussion in the market about GPS spoofing and all that. Anything, is that playing a role in that incident?
We have no indication of that, to be quite honest, on our ship. Also, ships have multiple layers of redundancy systems for navigation. So when you Google a ship and look at the AIS signal jumping around, that's the master have a much better picture where he is. So I wouldn't kind of speculate on that, but time will show.
And maybe Svein, could you just give us a sense of how has this market transpired? I know this is supposed to be a bit more of a finance discussion or finance weighted, but it feels like there's just too much happening in the market to ignore. So I think we have to spend a good amount of time on that. But what's happening right now in the market? Rates have started to jump. What's the charter's response been, and also maybe what's the ship owner's response been?
So there's all this question about the party. In a way, I think the party started 2.5 years ago. So we made just a couple of $100 shy of $50,000 on average for over 2.5 years. That's not a bad market. It's 20% over historical average. And I think the construct of the market going forward has a good chance of outperforming that average. So, of course, the events last week pumped up the spot market. The spot market dropped down to the sort of around 30, I would say, for a modern ship not too long ago. But with the events happening in the Middle East, it's people putting a risk pricing on, picking up this business. There has not been more cargo or less ships, I would argue. It's still sort of similar balance. But it tells you that still how tight the market is, that the owners are actually able to bump up the rates by this amount of money. So now, today is probably around $50,000 a day, up from, say, 30. So it's a significant increase.
And there's been, in the past, I guess maybe to Lois, there's been a lot of, whenever we have these dramatic moves higher, there's this fixing and failing element that takes place. Lois, can you maybe talk about what that dynamic is, and is that playing any kind of factor today?
No, absolutely. As an owner, you can control that to a degree. When the market is suppressed, and you put your ship on subjects, the charter, to a degree, as Lars has previously stated, has essentially a free option. And so as an owner, when the market starts to percolate, you absolutely have to step back and really assess. And when the market gets tighter, you could, instead of saying, it has been done through the years, instead of having subjects include stem, receivers, suppliers, everybody under the sun, really try to limit that down. But you definitely need a high level of really consciousness and awareness of, that your negotiating position has changed, and, really use timing on your side to put more factors on the side of the owner.
Yeah. Okay, thank you. And I guess, Mikkel, you get this question, which all of us get asked this, but what do you think happens if the Strait of Hormuz shuts? How do you think the tanker market reacts? And this can be followed up by other participants.
The easy ones. Thanks, Omar. First of all, you're going to see a scramble, and I think we're already seeing a slight scramble of the buyers of crude from the Middle East, which is most of the world. You're going to have 15 million barrels a day of oil that's going to be logged in. There's going to be a scramble to try and replace that, but it's hard to replace 15 million barrels of oil for the global demand. But I think we are seeing already now on the margin, just with the risk profile that we have in the Middle East, that the buyers of Middle Eastern crude, they are looking to see, well, in case this happens, where can I float some oil from elsewhere in the world? And as the rest of the panel can attest to as well, most of that oil has to come from further afield than where it is today. So we'll see how that goes. But it's a hard one to predict, of course.
Any follow-ups to that?
Well, we've been close to this situation before, so I actually seriously doubt that the strait can be closed for any prolonged period of time. Also, one needs to notice that, or understand that you're actually sailing in Omani waters when you pass the strait. That's where the shipping lane is going. But I think we can be exposed to delays as we proceed here. First would be kind of only daylight navigation. You could see potentially convoys, basically to keep ships safe. But you're talking about 14, 15 million barrels of crude oil kind of coming through that. And that's 35% of ocean-going oil. So there's no chance that that can be kind of clogged.
It's always been talked about, right, that the strait will close, but there's no precedent of this happening. And with the amount of oil, that's one thing, but also the US's Fifth Fleet is based in Bahrain. So I think there's an opportunity, or there's at least local abilities to ensure safety through this. Maybe you will get an air pocket and there's some noise for a week or 10 days or whatever, but for long-term or prolonged closure, I think is unlikely. And you look at marine insurance today, premiums have not gone up yet.
Okay, so that's
So it's an indication of sort of the risk consideration in the insurance industry. It's flat, at least for now.
Yeah, no, agreed. The world can't live for very long in a normal situation without the volumes that come through. So one would think that, I think when you look at the interests of, number one importer in the world, China, number two, India, these are customers that need their energy to be moved, right? So I think when you look at all the myriad of interests in the world, anything can happen because we're in a really dangerous place in the world. However, hopefully, I think there's a lot of complex discussions going on behind the scenes that will keep the straits open.
There was news yesterday, I think it was, the Qataris had mentioned, it was more LNG related, but said for LNG vessels coming to load to wait outside the Strait of Hormuz until called upon, which is a pretty significant development, it sounds like. Is that making its way yet into tankers? Mikkel, anything?
I mean, I think that's, I think to touch on what Lars said before, that's pretty sort of, when you have these hotspots around the world, you don't enter them until you have to. Convoys could be an option, only daylight transits and those kind of things. So you're not going to spend more time in these kind of hotspots areas than what you have to with your ships and with your crew. So I think that's a reasonable precaution to take at this point for sure. So that wouldn't be surprising to me.
Okay. And Svein mentioned that insurance rates have not yet gone up, which could change. Obviously, there's so many disruptive factors affecting the tanker market and shipping overall, and perhaps just simply the global economy. But when we think about like the risk factors and the dynamic, there's the Red Sea situation, and now you have this Middle East situation. Based off of what's happening now, what's riskier, going through the Red Sea today or going through the Strait of Hormuz?
Well, if the insurance market is anything to go by, the Red Sea is riskier. But I think, the market seems to look at all this air missile activity to be sort of contained to that, at least for now. Whereas the activity you had in the Red Sea was very much ship-related, right? And it was very hard to defend yourself as a ship. It was hard for any navy to try to prevent these things from happening also, and trying to shoot down all these drones and whatnot. So, but for us, we decided not to go through the Red Sea very quickly when the shit hit the fan. I think for now we will go to the Middle East, but of course things can change, and then you need to change your policy and what you're going to do. And there is a bit of a standoff now in the market. Not everybody wants to go, but we saw earlier this week that people were willing to go just when the freights went up sufficiently, right, to worst case 70. So.
Yeah, and then I guess for the Red Sea, one of the things initially that was talked about a year and a half ago when it started was the idea of convoys. Which I think it seemed like a lot of companies poo-pooed that and said, I'd just rather divert and not deal with that. Do you think that it's different if this progresses aggressively, that the use of convoys is accepted as the way to go, or is that the only option basically to go through?
I think it depends what kind of risk the ship is exposed to. And the convoys helps you if you have skids and other sort of smaller vessels, approaching you, wanted to attack you and so forth. But if it's aerial hostility that you're facing against, a convoy doesn't really help you much. You actually concentrate the assets that can be hit. So it's a very different situation. So I think what has to be contained there is the risk of a nation like Iran wanting to, expose or attack naval vessels. And so for now, at least, that's not been a risk, but I'm sure they have the ability to do it if they want to.
And then just sort of maybe Lars to talk a bit about, because Svein had mentioned earlier that what we're seeing is perhaps just no change in necessarily volumes perhaps, that the supply and demand balance is kind of the same, it's just the risk premium has elevated rates. Are we not seeing at all charters come in aggressively and either buy barrels earlier than normal or secure ships sooner? It's just simply a risk premium event, not an actual activity?
Basically what we've had ever since Friday is something that kind of can be explained as a Mexican standoff between charterers and owners. But some deals have been concluded, and quite interestingly, the July dates in AG are working quite early, actually. But I think if I was the refiner in Asia, and they do, Asia as a whole kind of import about 24 million barrels per day of crude oil. I would, if I was going to decide where I took the marginal barrel from, it's probably going to be Atlantic Basin. But it's a bit early to see that in the market. But we have seen some of the Asian refiners potentially being more aggressive on West African volumes. So I think that's probably hopefully the playbook we're going to see can transpire as we move forward here. If you are an Asian refiner, we are in this kind of very fluid situation in the Middle East. You probably want a bit more inventory as well, or I would, and then you will reach further out. And it's extremely powerful, this ton-mile effect of a barrel coming from U.S., Brazil, or Guyana or North Sea rather than the Middle East.
If I just may add, I think the diversification of the procurement activity of all refiners in Asia is now much more broad than it's ever been, because there's been more supply also coming from Atlantic, which essentially is long oil. So most people already have procurement in West Africa and Brazil, Guyana, US, even North Sea. And that's very different from sort of prior war activities back in 2003 or 91 and all other situations.
Yeah, so clearly when we think about, this might be an unanswerable question, but just to throw it out there, geopolitics have played a significant role in tankers. It seems like every theme over the past 3 to 4 years has been geopolitically related. And the good old-fashioned oil demand side of the equation doesn't really get mentioned. Maybe from a diversification of sources that you're just highlighting, Svein, but generally, how do you think this tanker market looks like if geopolitics wasn't giving an assist like it is today?
I mean, you've got 110 VLCCs on the OPEC list. So that is, political, but it's a fact. And let's say, hopefully peace breaks out across the world. What are those vessels going to do for trade? So, you have to deal in this world of, okay, right now they're still trading to some extent. However, hopefully there's only one way off the OFAC list, and that takes those vessels out of play. And you already have a finely balanced market. That's just the V's. That's not the whole list, right? And then you have a very positive market for all of the publicly traded owners who are trading compliantly and investing in their vessels in the proper way.
I think we had to try to answer that a couple of years ago. The last time we probably didn't have a massive geopolitical impact was end of 21, early 22, and because there was a window there where we could see that the oil entering the water or going on to tankers, i.e. creating demand for tankers, were back to what it was pre-COVID. But we could see the ton miles and the ton days wasn't quite there. Obviously that changed end of February in 22. And since then, you really haven't had a sample size of any significance where you can try to run that scenario you're talking about. But trying to take geopolitics out of oil and the transportation of oil, I think that's almost counterintuitive.
No, it's it's quite depressing actually to look at if you take a line from 2022 until till now, the volumes available to sail for the compliant fleet has actually shrunk. The incremental barrel is coming from Venezuela, Iran, and Russia remains stable, but sanctions pressure in the increase. So you have kind of you have about 7 million barrels of oil sitting. So if you like Lois said, if you suddenly took away all the geopolitics, we would be in a raving bull market for the compliant fleet. But I think kind of looking forward, if you look at where is the next barrel going to come from, well, OPEC, and then you have kind of promising developments in Brazil and Guyana. I think the next barrel coming into the market will be a compliant one, and it needs a compliant ship. So I think I'm not going to say we've turned a corner just yet, but I think we're closing in on it.
Okay, and yeah. So maybe just on that point, we're going back a week in a simpler time when it was just simply OPEC's going to bring back barrels, the ships are on the OFAC list, tanker rates go up. That hadn't happened, or when do you think, absent what we're seeing now, when do you think we actually start to see those OPEC barrels come to market and start to really push the VLCCs and the tankers overall?
Well, the barrels have already come to the market, but in a sort of minuscule way. So at the get-go, the increase was only sort of just north of 100,000 barrels a day. And from where we're sitting, we think that what was happening is that cargo sizes was just increased a little bit, so there wasn't in more shipments, but just a little bit more cargo at the get-go. Now we are in sort of the peak heat season in Saudi, so the increased production now is predominantly going to power generation. And in prior summers now recently, Saudi has imported Russian fuel oil. Now they seem to do less of that and consume their increased production. Our 2 cents is that we will see these barrels actually come to the compliant freight market from September. I think there's some visibility on this and fair expectation of that happening.
Just to add to that, it's sometimes difficult to hear, but so sorry if I repeat or if it's an echo. But the first kind of iterations of OPEC increases, I think, was just to catch up to the molecules that were already in the market. So it's merely a paper exercise. But I think kind of coming, into July, August, September, depending, of course, that they continue the policy, I think that's when we'll see some more volume. But I 100% agree that we need to probably wait until after the cooling season in the Middle East until we have the full impact.
All right, so it seems like the fall season can be the trigger. Was mentioning earlier that your stocks are up on average 30%, and this may be for the second panel. I think Frederick is going to be moderating that one, but the product tanker stocks are down maybe 3 to 4%. So there's been a real kind of divergence in terms of how investors are viewing the sector. They love VLCCs, they're okay with the mid-sized crude, but they've really hated products. Given the dynamics at play, what we're seeing today, what could potentially be coming in September as those OPEC barrels come, can you actually have a bifurcated market where crude is celebrating and then product is still kind of languishing?
We have product here, so I'll take that one. You can. It has happened. I don't think it's happening here. When you look at the market, today, diesel margins have spiked in Singapore and in Europe. So when you sort of see that, it generally the pull comes from the product side, and then the call on crude comes, right? So, you're seeing a world that is nervous and wants to make sure that they can secure their product, right? So, we're completely linked, and I think with the state of play in the world, there is a base under the refined products that it seems like we have found, and it's a much higher base than, what you had 5 years ago. So I do believe you can, Omar, but I don't think you're going to do it this time.
Okay.
Just a quick comment there. I mentioned this Mexican standoff situation, and there's actually been a serious Mexican standoff on LR2s in the Middle East. And I'm happy to share that World Scale 200 is now crossed, and we're talking about north of $60,000 per day. So, you know, there is some action in that space too.
Great. So I guess this is a bit more of like a question in terms of managing a business, right? Just given everything that's happening, right? The complications continue to, you know, grind upwards. How do you manage the business in this environment? Is there anything you're doing differently as a result of what we've been seeing here over the past several months? Or is there something that you're not able to do because of what's happening?
I think probably more than ever, it's important now to remind ourselves and the company that what got us to where we are today, where do we want to go, and don't get too distracted. Of course, we have to focus on what's going on in the news, what's going on in the headlines, and manage that as it happens, but you can plan long-term basis tweets. Thanks for showing the video. We were just celebrating 30 years on New York Stock Exchange. We just celebrated 52 years as a company a couple of months ago. We want to be around for the next 50 years. I think knee-jerk decisions in terms of what's going on right now, that's probably not going to get us there. So, of course, we have to manage the risk in front of us because things happen as we've seen in the last week. But getting, of course, from a safety and security point of view, getting that right is absolutely critical. But at the same time, it's not going to get us to another 50 years. We have to keep an eye on that as well. So I think that ability to go and just check, well, does this align with what we're trying to accomplish for the next decades? That's what keeps the focus in the right place for the long term. I think that's more important than ever right now.
I'm going to say that, you know, I think difficult times really show your character, and, you know, we are on security briefings, and I would say the customers, you know, big oil is, you know, very well informed, sharing information freely with us. You know, we're on with the U.S. Navy. That level of coordination, and it kind of puts in stark relief, you know, the respect for the seafarer out there who's on the challenging end of all of this, and what it is we're really doing. Everybody up here, you know, running these companies and the challenges that are out there in the field. So I feel closer than ever to the execution of what it takes to deliver, you know, deliver your energy, deliver oil to the world.
Great. Separate but related topic, balance sheets in the industry have strengthened materially over the past several years. Obviously, Teekay, you've taken advantage and paid off all of your debt. And you know, you sit with a cash pile that just keeps building and building. But everybody here is generally underlevered relative to where they were in the past, which is a great thing to, you know, in terms of comfort. Is this the new normal for the industry, to have leaner balance sheets?
I think, you know, what we've been doing is, you know, we were a bit ahead of the rest of the pack in delevering, with a view to structure a capital allocation policy that we focus on should be sort of sustainable over time. Because too many times, historically in shipping, people have had to change tack and how to do things too often, and of course then you reduce the credibility for the investor because they never know what's happening. So I think we've been able to come to that level. And that construct, I think, shows you now how some of the companies are priced, right? That they believe in what you're doing can actually happen. So I think to have a new time with sort of very high leverage is maybe past us, unless you know, always have somebody who can step in and, you know, rescue the company, so to say, right? But I don't think any of these companies here have that sort of feature set up. You have to be a sustainable company. You have to think long-term about how you allocate your capital. It has to be very clear and simple and easy for investors to understand. So I think lower leverage is here to stay, in my view.
But you know, I think it's, you know, different from company to company, you know, how you define high or low leverage. You know, we're of the opinion that kind of, you know, with reasonable leverage, as we call it, we're actually offering our shareholders a little bit more of the pie. You know, one share of Frontline gives you 1.5 ship exposure. But you know, it's all a question about where do you think we are in the asset value cycle. And because the, you know, the LTVs are obviously governed by how you value the fleet. we are of the opinion that kind of just looking at the global supply picture on tankers and also the average age of the tankers, and this is something we started to kind of put in our strategies in 2020, is that we see it's a very limited downside in the current asset values. Of course, they will fluctuate. They have fluctuated down a bit, but for asset values to reduce by say 30% over the next quarters, I think that's almost unthinkable. Looking at the supply demand on the shipping side.
Lars said the word cyclical. We know we're in a cyclical business. I think that, where we are right now with our balance sheets is fabulous. We're in a position where we have over $600 million of liquidity, a similar level of debt, and, over $3 billion in assets, right? So, importantly, I think wherever we are today, that allows for us to look and be ready to take advantage of the market cycle as and when it presents.
And speaking of just ship values, I feel like we've gotten through 30 plus minutes of a panel and not talked about NAV, right? Which is fantastic. But values have been firm, right, as we've talked about, and you don't see a 30% correction. It clearly doesn't seem like could be realistic. But when we think about values in today's market, in the 2000s, you could say the public companies perhaps were responsible for the rise in asset values, just given the private to public arb, the valuations at the time. And then in the 2010s, you had the private equity that came in and spent a lot of money driving asset values higher. What's been keeping asset values this cycle high? Because the public companies aren't buying ships.
Obviously, besides earnings, of course, but also new tonnage entering the market as well. But there's been pressure on prices has been going higher at the yards as well from support from other segments. So it's been difficult to. So again, that bottleneck for the tanker market has of course supported earnings. We had the geopolitical events that we talked about. So that's kept it high, and plus the lifespan, whether we like it or not, of the average tanker has expanded due to other markets having opened up. And if you can trade the vessel for longer, of course, the valuation is going to last for longer as well.
And I take that back, by the way.
Just a little comment there.
Yeah.
We're tankers, right? But I think we've kind of been a little bit saved by the adult ship owners, the container owners, the LNGC owners, and those guys that don't run around ordering a gazillion ships that they don't need. So they've done their job to prevent us in the tanker business to do something foolish.
Yeah. Great. Well, we have 1 minute left, and I did want to ask just one final question. It's a bit, hopefully we can bang it out in a minute, but 5 years from now, we're going into 2030. Where do you see your companies? Just be quick.
Yeah. Bigger and younger and on that journey to decarbonization, absolutely.
Lars?
Yeah, no, hopefully we paid out a lot of dividends by then. It's very difficult to answer, to be quite honest, because we also have kind of a road to decarbonization. It's important to us too, but hopefully by that time our clients are willing to pay something for it.
So with the information available today, DHT will be more of the same. Hopefully we can also grow, but that's not a must. But it will be more of the same, good predictability, laser focus on earnings per share and how to distribute value to our shareholders.
Our #1 priority right now is fleet renewal, and I hope in 5 years that would have been accomplished, and we're well positioned to take advantage of what's going to come ahead for the next many years after that.
Lovely. Okay. Well, thank you. That wraps it up.